Welcome back. Let's talk to Connor Campbell. He's a financial analyst at Spreadex. Morning to you, Connor.
Morning.
Right, let's have a whiz through. We've got 3 stocks to cover in this video. First one, Admiral Group, stock code ADM. What's the highlights here?
Well, it was actually it was in a bit of danger at the start of the year. It had to push back its full year results from the end of February to the start of March because of changes to the Ogden rate. That's the rate used to calculate, so the discount rate used by UK courts to calculate personal injuries, like damages, the awards and stuff like that. And that had a really, really big impact on its full year figures. Originally, Admiral Group was in line for a 3% rise in pre-tax profit. Changes to the Ogden rate caused a 25% fall in pre-tax profit. It lopped off £105 million, in one fell swoop, basically. However, it maintained its dividend. I think the dividend was 114.4p for the year. That, as you can see, just at the start of that chart, you had that sharp dip in February. That jumped back again as it maintained the dividend. Investors were reassured that Admiral Group wasn't letting it affect, its sort of fundamentals really. And since then, it's done very well. It's, maintained 2050, for most of the year. And then the last few weeks, basically since the start of August, there was a report in Forbes. It was pointed Admiral Group as one of the stocks to pick, mainly due to the Association of British Insurers saying that UK motor insurance was an all-time high over the second quarter. So that bodes very well for Admiral's half-year figures this week. I think revenue is expected to more than double year on year from 260 million to around 552 million. Earnings are expected to be up around 2.4%. Very healthy figures. The only downside is it's climbed quite rapidly in the last few weeks. It's looking quite high, highs in 2017. It does mean that the slightest bit of bad news really could drag it a bit lower. Our clients, however, they're happy with where it is. I think they're looking at the prospect of that really chunky increase in revenue and thinking, yeah, we'll hold at the 2150 mark. They're buying around that level.
Understood. Let's go on to Hikma Pharmaceuticals, the mnemonic HIK. That's a pretty weak looking chart, right?
Absolutely awful. Yeah, things were going very well at the start of the year. March, you can see that sort of spike in March. It was 7-month highs. Full year sales had jumped 35% to $2 billion. And more importantly, it said it was starting production on its own asthma drug to rival, its own generic asthma drug to rival GlaxoSmithKline's Advar. Obviously, GlaxoSmithKline have had a lot of trouble recently since they lost their patent for Advar. That's going to seriously impact Glaxo, for the next few years, especially as competition increases from various companies producing their own generics. However, cut to May, and the FDA had rejected Hikma's asthma drug. Obviously, that was a huge blow to the company. A week later, it was its first quarter report. That had to drag their full year forecast down from previously. I think they were expecting 2.2 billion in sales. Now they're expecting between 2 and 2.1 billion dollars. Its generics business also took a huge hit. They were expecting 800 billion dollars in full year sales. That's down to 670 million with the loss of that asthma drug. Since then, as you can see, there's been no real good news. A note from Morgan Stanley sort of just kept the losses coming because they said that whilst analysts' forecast for the company had been reined in, they hadn't been reined in sufficiently.
Right.
So, again, doesn't bode well. You can see basically in the last couple of weeks, it's trading at 3.5-year lows. There just has not been any good news. And it's sort of hard to see what they can really do to turn things around at the moment. Its figures this week, it's expected to see an 8% jump in revenue. So, that in and of itself is impressive. However, without any news on the asthma drug, it's hard to see if investors will be willing to get on board. It doesn't look like the asthma drug is going to be improved by the end of the year. That does seriously impact its short-term future. However, our clients have been really, really heavily buying around that 13p mark. I think just because it is at 3.5-year lows, there's arguably not much further it can go.
Famous last words.
Like that exactly. But that 8% jump in revenue could be enough to reassure investors as long as there is no more bad news about the asthma drug.
Understood. Let's wrap up with Kingfisher, stock code KGF. Again, not a great looking chart.
No, it's got some serious French issues, basically. Its figures recently, its full year figures back in March, were overall very strong. I think like-for-like sales, total group like-for-like sales were up 2.3%. Pre-tax profit was up 14.7% to 787 million. Very healthy figures. UK and Ireland like-for-like sales, I think they were up 5.5%. However, or 5.9%. Sorry. However, in France they were down 2.7%. Not very good. It also warned on Brexit uncertainty, and it was still cautious on its French outlook. Remember, this was before the French election, so that was still looming for the company. Cut to its first quarter figures in May. The divergence between the UK and France had only increased, really. In England, they were up, like-for-likes were up 3.7%. That was mainly based due to Screwfix. Sorry, Screwfix is doing very, very well. I think their like-for-likes were up 15% compared to sort of a slightly less robust situation with B&Q, where they're closing a lot of their stores. In France, however, like-for-likes were down 5.5%. In France, its main stores are Brico Dépôt and Castorama. They're really not doing well at the moment, and that's having a serious impact on its stock performance, as you can see. Heading into its half-year figures this week, investors are really just going to want to see some kind of turnaround in France. I think that's the main issue. And if it can't produce a turnaround, it could just be, like-for-likes are down 2% or like-for-likes are down 1%. It doesn't have to be creep into positive territory, just some signs of a turnaround. They're also going to want an update on the company's one Kingfisher restructuring plan. That's meant to deliver 500 million extra in profit from 2021 onwards. That's a few years away, so it depends on how willing investors are to sit at the sidelines and wait for Kingfisher to work some things out, because they had said in May that there was some business disruption due to the restructuring plan. So if there's any more of that this time around, that's going to hamper the stock. Ditto, the UK retail sector is not in great shakes at the moment. In the last couple of months, you've seen plenty of warning signs.
Yep.
Stagnant wage growth, falling retail sales, etc. So there aren't a lot of good signals heading into this half-year report. Sorry. However, our clients are buying around that £3 mark in August and July. It was at 2.5-year lows. There is room for it to climb without it being a drastic improvement on where it is, basically.
So just to wrap up there, we know that gaps always get filled. There's a big gap on that chart, up to £3.60. And if you look at your textbooks as well, that looks to me as if it's an inverse head and shoulders, which is basically a bullish chart pattern on a break of the trend line, sort of around the 310 level. Connor, thank you very much for your time.